Dow Jones is 200 points up, or Dow Jones is 150 points down. You constantly hear this when you pay attention to financial news. Why is it so important to pay attention to changes in Dow Jones index? And why is it important not only for US market participants, but for participants around the globe? Hi, my name is Igor Vasiliev, and during this video we're going to discuss the importance of this index for us as investors. It's first. Secondly, we're going to look what kind of companies included in that index and why. And thirdly, we try to understand, is it possible to invest in this index? And if yes, how we can do that? And of course, the best question, when is the best time to put money into assets related to this index? So if you'd like to know more about this index, stay with us. And at meantime, you can click the like button and subscribe to our channel in order not to miss the next videos similar to that. Dow Jones Industrial Index was created in 1896 by Charles Dow. That's where the name came from. And at that time, they included 12 biggest companies in the United States. And here you can see the list of them. As you can see, none of these companies exist in the index anymore. General Electric was the last one to be replaced by Walgreens Alliance in 2018. They added more companies to the index in 1928, and since that time we always have 30 companies in that index. Currently there are 9 major industry sectors of US economy included in that index. And as you can see, they are not evenly spread. Another important thing to understand is that the companies included in this index can be changed. So if the company is losing their market and it's kind of becoming not as big and important in the industry and becoming not a leader and replaced by some other company, so the company can be replaced in the index too. There are some years when we don't have any changes, and there are some years when we have couple companies come in and couple companies come out of the index. Let's have a look at the current list of companies included in this index. As you can see, 30 companies. And the interesting thing about it, that the companies are not equally weighted. So if you pay attention to United Health Group, its weight in the index 10%. So it's 1/10 of the index is allocated to United Health Group. Then Goldman Sachs takes 6.35%, Home Depot 5.87%, and etc. So, and we can see that Intel Corporation is taking only 0.8% of the total index value. Now, the interesting enough, if you compare two different indexes, for example, Dow Jones and S&P 500, so you'll see the difference in composing those indexes. Now, when the Dow Jones is composed, it's composed based on the price of the share. So the higher the price of the share, the bigger allocation of that particular company in the index. Whereas if we go for Standard & Poor's index, there would be a different allocation based on capitalization of the company and not on the price. And it's quite interesting because if you pay attention to the list of the companies and think, okay, Apple has much bigger capitalization than, for example, Home Depot or Goldman Sachs, but it's actually 17th on the list. Why? And the main reason, because price of the share of Apple is much lower than the price of the share of Goldman Sachs. When they compile the index, they don't just add prices of shares together and then they have the total value. No, they have a certain proportion and a certain formula in the way they do that. But in any way, price of the index depends on the price of those companies. So that's why when the performance of one or another company is deteriorating and the price of those particular shares are dropping down, it affects the index. And by looking at those proportions, you probably understand that if United Health Group Incorporated is going to lose 10% in its share price, so it's going to affect the index nearly for 1% because it's 10% of its valuation. And if the same thing happens to Intel, So it's practically not going to affect the index as a whole. And that is why majority of economists, they recommend to look not only at one index, but at the rest indexes as well. Let's have a look at price changes of Dow Jones during the whole period of its existence. And as you can see, that initial price when it's opened, it was $29.39. The interesting thing about it, when we look at the price chart for the last 100 years, so we practically don't notice the falls which happen here. And for us, they're insignificant compared to the current price. But when we come closer to the last couple decades, right, those falls are already noticeable. But I'm going to tell you that it was exactly the same during the previous 100 years. There were tough times in economy when the index could fall 30, 40, 50% or more. But if we look over time, the index constantly growing. That's why in 50 or 60 years time, these falls in 2000, 2008, and 2020, we even won't notice them. And if you're a stock market investor, you invest in different businesses, you can put money in certain companies that can go into liquidation and bankruptcy, and you can lose the investments there. But if you invest in index itself, there are some times when the index goes down, but this never happened that it goes to zero, that the whole list of companies included that the index goes into liquidation. And the main reason for that, as I already explained, that companies in index, they are replaced. So that's why a lot of analysts, they recommend investing in the index. You invest in generally in all list of companies included in them. Of course, when is the best time to invest? The best time to invest when the price is at the bottom. And we see it in 2002, we see it in 2009, we see it in 2020, and we see it now. But the thing is, we never know that it is a bottom. Because if we look here, the price fall of the index Dow Jones was nearly 40%. Here it more than 50%. Here we had 37% drop. Now, is it the end for the current fall? Or is it going to recover right now? Or is it going to continue the fall? And there are a lot of factors which can influence that. But generally, if you invest in this index, even if it falls lower, it recovers and even makes more money for you in the future. So, how can we identify when is the best time to buy the index? Some people will argue that it's much better to invest in individual companies rather than in a whole index. And of course, they might have a very good point here. And the main reason for that, when the index falls, not every company falls in price. Let's have a look at this list. And as you can see, that this is a performance of companies included in this index for the last week, month, quarter, half a year, and year to date. At the moment it's July, right? So we can see that majority of companies, they fell in price. We can see that Intel Corporation 29%, WB 26%, right? Cisco 32%. But there are some companies, they're kind of flat in price. Would say if you look at United Health. And some companies, they during that period of time, they grew. CVS Health, and we can see that Merck. So when the rest of companies were falling, those few companies were growing. And of course, if you allocated your capital only into these companies, you're going to make money while other people are losing it. Of course, there is very important question. Why some companies are falling and why other companies are growing? And of course, it depends on fundamentals of the business itself. So if the company has some challenges during this time, and a lot of businesses do now, they are losing some sales, of course it affects their profitability, earnings per share like going down, and as a result the share price goes down as well, because it's increased the fear of investors, it doesn't create certain confidence for them, and of course they withdraw the money, so they start selling the shares, and as a result the share goes down, share price goes down. But if the other company, instead of that, keeps growing, keep increasing their sales level, increasing their profitability, acquiring new markets, people reallocating capital from the companies which they sell to the companies which keep growing. This is very important factor. The second factor which also affects the price is the valuation of any particular business. Because quite often when everything is rosy and the market is growing, people just throw in money into anything and they buy at any price. And only when the tough time comes, they start evaluating those companies and they start compare the value of the business and its price. And if they see that the company is overpriced, so the price is too high, and it's not based on the dollar value, it's based on the valuation metrics, like for example, like P ratio. When they see that price earning ratio is too high, they start selling it because they're afraid that if the earnings are reduced, the price can just go down quite a lot. Look at some companies recently, how they fell in price. Amazon, PayPal, Facebook. These are great companies, but still they fell like stones on the market. Let's have a look at some parameters. We can see that UNH, P ratio 28, next year forward P ratio is 20. It means that the company has a projection to grow and quite significant growth. When we see GS, so Goldman Sachs, we see P ratio is 5.8. So it's very, very low. But the next forward P ratio is 7.3. So they expect a reduction in their earnings. So if you just go through this table, if you pause the video and go through the table, you can see that some P ratios are very, very low, around 5. And some P ratios are very, very high, like nearly 65. By the way, if you're interested, I can go through each individual company and go through fundamental and technical analysis of each particular company included in that. So if you want it, please put in comments which company do you want me to start from, okay? If you decided to invest in the index itself, but not in individual companies, of course you do exactly the same valuation. And look at this particular Wall Street Journal page. We can see that Dow Jones, as any other security, has P ratio. And on the 30th of June 2022, P ratio was 17.6. If you go back 1 year, it was 29. The interesting thing about it, if you open the charts and look at the price, which was last year for Dow Jones, you will see that the price was around 34,500. So, which is roughly 10% above current price. So the price roughly fell 10% compared to the last year. But P ratio dropped nearly 40%. So the question, why? So the main reason for that the earnings of those companies included in this index, they actually grew during the last year. But the price fell. Why? Why people paying less for the same companies which now making more money but less amount? And the main reason is fear. People afraid because there are so many unknowns right now. There are so many fears right now in the market. They're selling their shares and withdrawing the money. And as a result, you can buy exactly the same companies which are making more money now for the less price. Is it possible that the price of the index falls even lower? Of course it is. But you still have to remember that buying these companies right now is much cheaper than it was last year. So the question is, if I like it and I want to buy, how do I buy index? Is it possible to buy index? Unfortunately not. You cannot buy the index itself. And even though you cannot trade the index itself, you can trade derivatives of it. And the most popular are futures, options, warrants. But you have to be careful with that because they have an expiration time, right? You cannot be investor if you just buy option. You cannot hold it for years and years, right? They're going to expire. Same related to futures and warrants. But if you want to be as a long-term investor, you can buy exchange traded fund, and one of them is DIA, the ticker. So you can go and buy it. Another advantage of buying exchange traded fund is that you're paying much less money. And instead of paying $30,000 for one unit, you can buy only for 310 one share of its ETF. And if you notice, it actually replicates the movement of Dow Jones index. So when is the best time to buy? Again. So of course, when it is fear on the market, when people are afraid, when they're selling off, when the P ratio of the index is going to go down. So is it the best time to buy now or not? We don't know, because the market can keep going down. There is a lot of fear about upcoming recession. And a lot of people and analysts, they are saying that it's going to be much worse than previous ones. Now the question is, what should we do? Should we keep it cash, or still should we keep allocating some capital? Because if it recovers quickly. And a lot of analysts, they recommend to do a dollar averaging. So if you decide to buy it, you put $1,000 now, you put $1,000 next month, you put $1,000 in 2 months time period. And what happens? If the price falls lower, so by using another 1,000, you actually will be able to buy more of this ETF. So more shares of this ETF. And if it falls lower, using $1,000, the third lot, you can buy even more. So, and if you keep doing it, and then when the market starts recovering, you're averaging your price down, and after that your profitability wouldn't be as perfect if you bought everything from the bottom. But as I say again, it's impossible to know when the bottom is going to be. Guys, I'd love to hear your opinion about if the market is going to crash completely, or is it going to recover, and when do you think it's going to happen? Put it in the comments. Also, I'd love to know if you want me to go through financial analysis of companies included in this particular index. Also, write down exactly what company do you want to me go through first, secondly, third, and I'm going to do that for you. And of course, if you like this video, put a like, subscribe to our channel, and share this video with somebody who do you think going to benefit out of it. Thank you very much. All the best.